15.15 lakh crore rupees. That is roughly 180 billion US dollars. Recently, Indian regulators issued an interim order centered on this single staggering figure, alleging it represents years of misrepresented revenue by one of the country's largest gold exporters. The company is Rajesh Exports, or REL. For decades, it cultivated the image of a global refining titan, reporting annual numbers that rivaled the scale of international tech giants. This empire was steered by its founder and chairman, Rajesh Mehta. But the 2025 financial report contained a mathematical anomaly. On the left, a towering gross revenue column of 4.23 lakh crore rupees. On the right, the net profit, a microscopic 95 crore. That implies a net profit margin of just 0.02%. Operating at a structural margin of 0.02% is a statistical tightrope. One minor shift in global gold prices, or a single logistics delay, would theoretically wipe out the entire year's profit. In reality, numbers this thin suggest the company's global scale is an illusion. Red flags began to appear in 2023 when the company failed to publish its comparative cash flow statements. Without these records, it became impossible for investors to see where the physical cash was actually moving. Then, in 2024, a shareholder complaint about massive unpaid customer dues prompted the Securities and Exchange Board of India, SEBI, to launch a formal investigation. When forensic auditors attempted to verify the company's books, they met a wall of non-cooperation. For a sample of purchase transactions totaling trillions of rupees, the company could only provide complete documentation for 2% of the requested data. This wasn't just a corporate dispute, it involved public money. The state-owned Life Insurance Corporation, or LIC, held nearly an 11% stake in Rajesh Exports, meaning millions of ordinary insurance policies were tied to this uncooperative entity. The refusal to provide basic receipts turned a standard audit into a hunt for missing trillions, leaving the public's savings highly exposed to a potential collapse. SEBI's investigators found that 99% of the company's total consolidated revenue was generated through its overseas operations. The accounting trail led from REL in India to a Singapore subsidiary, then to a Swiss holding company called Global Gold Refineries, or GGR. GGR, in turn, owns Valcambi, a prestigious gold refinery in Switzerland. At the bottom of the chain, Valcambi's audited books showed the truth of its business. It primarily earns modest processing fees for refining gold that belongs to other clients. However, the holding company GGR, which is legally unaudited, recorded the entire gross value of the customer's gold as its own revenue. Rajesh Exports then absorbed these unaudited figures into its Indian reports, bypassing the refinery's actual audited income. When regulators asked for proof, the company claimed that Swiss privacy laws prevented them from disclosing subsidiary data, a defense the regulator rejected, noting those laws protect individuals, not corporations involved in financial probes. By exploiting an unaudited foreign middleman, the company used the prestige of Swiss gold to legally camouflage a trillion-rupee accounting illusion. The investigation then shifted from these overseas billions back to the company's domestic standalone books in India. In its Indian records, Rajesh Exports claimed to have conducted over 11,000 crore rupees in sales with a domestic stockbroker called Affluence Shares and Stocks. But the brokerage officially testified to regulators that Rajesh Exports was never their client. They had no commercial trading relationship with the company whatsoever. Bank records revealed a different destination for the money. Corporate funds were being routed into the chairman's personal account to serve as margin money for his high-risk derivative trades on the commodity exchange. After tracing the chairman's personal losses on these trades, investigators found those same figures appearing on the corporate ledger, recorded as massive, fictitious gold sales to the public. Using personal, high-risk derivative gambling to generate corporate revenue demonstrates a systemic effort to artificially sustain the company's valuation. SEBI's response was immediate. They barred the promoter from trading and mandated a complete, fresh forensic audit with full access to the company's systems. The market reaction triggered a massive destruction of Rajesh Exports' stock value, causing a rapid decline that trapped both institutional investors and retail shareholders. The company has rejected all charges, claiming the 15 lakh crore discrepancy is simply a confusion by the regulator, who they say mistakenly used EBITDA figures instead of revenue. Regardless of the defense, the market's loss of trust has already erased real-world wealth. The damage is done, based on an alleged paper facade that hid the true health of the business. Beyond the specific actions of Rajesh Exports, this case reveals a much larger vulnerability in how the world's money is monitored. The Swiss shuffle demonstrates how easily international disclosure frameworks can be bypassed using unaudited holding companies to mask the actual operating reality of a business. It also highlights a failure on the domestic front, specifically how auditors failed to cross-check 11,000 crore rupees in sales with the very broker supposedly making the purchases. If a company can fabricate trillions of rupees in scale for half a decade without detection, it suggests that global corporate governance is far more fragile than we are led to believe.